YouTubers. Last video I was talking about Brookfield Infrastructure Partners, and basically one of my core positions right now as I feel energy infrastructure type plays, their dividends should be pretty safe. I mentioned there was some FX risk in Brazil because they're not hedged against the real. But also one thing I liked is 85% of their long-term debt is long-term, so they're in no rush right now to do a lot of refinancing in this environment. Also, their dividend last year increased by 7%, and they're still got a target growth rate for their dividend between 5 and 9%. So that keeps up with inflation and beats inflation by 1 or 2%. Whether they can do that this year under the current environment is questionable, but they do have a good track record. Also, last year, this company does do quite a few acquisitions, the nature of its business. But organic growth, that's just growth within the company without any acquisitions, was pretty strong at 10% with a funds from operation of 358 million. So, and they have liquidity of roughly 1.4 billion. So the only thing I don't like about Brookfield, because there's, like I mentioned, Brookfield Energy Partners, which I own. This is Brookfield Infrastructure Partners, and there's one or two other Brookfield, so it's hard to kind of analyze the company because all the different interrelationships between the different Brookfield entities. So it's not an easy one to really sit down and go through the balance sheet, that type of thing. But overall, I think it's a good addition to my portfolio right now in this climate. That being said, though, I did buy a technology company. Let me just get it here. And it's Pure Storage. So when we have big market corrections like this, I still like technology companies, new technology companies, because the prospects of high growth, like 15 to 20% revenue growth, maybe for lots of years, if they've got innovative ideas. So I did find Pure Storage, which went public back in 2016, and the price got as high as $30, and recently came right down to $8. And unfortunately, I missed that $8 price. I ended up picking it up around $12, just a small amount. And what they do, it supplies continues to grow and strive to mine intelligence from data. A need for real-time analytic increases. They focus on delivering software defined for data storage solutions that are uniquely fast and cloud capable, enabling customers to maximize the value of data, gain competitive advantage, and keep pace with the cutting-edge developments. But the key here is their innovative data platform replaces storage systems designed for the old type mechanical hard disk with all flash system optimized end-to-end for solid state memory. So basically it's the cloud area is fairly competitive, but it's new. As we know, we download more and more software from the cloud, or we save more and more information to the cloud. and but this is using all solid state memory, so it kind of differentiates from the other cloud companies. And I thought it was interesting just to be able to pick it up below the IPO price a couple of years ago. They have been losing money for the last couple of years, but they did go cash flow positive last year and I think this year, and they should have earnings possibly this year. So I'll go into some more of that when I go through my spreadsheet. But they supply a diverse set of industry verticals, so consumer web, education, energy, financial services, governments, healthcare, manufacturing, media, retail, and telecommunications. Their data services are used for a broad set of cases, including database applications, large-scale analytics, artificial intelligence, and machine learning, which we knew is a new field that's starting to get quite popular, where you take lots of data and from that try abstract some types of patterns, and that's an area that's going to continue to grow, and then you analyze all that data with some type of artificial intelligence. So also private and public cloud infrastructures, web scale applications, virtual service infrastructures, and virtual desktop infrastructures. So their data platforms help customers scale their business through real time and more accurate analytics, increase employee productivity, improve operational efficiency, and deliver more compelling user experience for their customers and partners. So it's just an interesting company, especially the all-flash data hub. I think it makes it a little bit unique in the cloud field, plus the use of data analytics, artificial intelligence, that just I think makes it stand out a little bit more. And if they can continue to grow their earnings, grow their revenues around 20% or so, it's just a matter of time before they can start developing some reasonably good earnings, and it wouldn't take too much to justify the share price up to the $15-20 range. I do hope this one does correct a little bit back down to hopefully 10, or if I get lucky to get $8 again, I definitely will add to it. Though I think they are going to be affected by the coronavirus like any other company, but noticing a lot of the technology companies not correcting quite as much as the market overall. So I went through their spreadsheet. One thing with a company that's actually burning cash, doesn't have any earnings yet, is the amount of cash they do have on hand and any financing. So their financing was actually done, they raised $575 million through a convertible bond with an interest rate of 0.1275%, and that converts, and that can convert to shares at $26.27. So we're down at the $12 area. It would have to double for those shares to even convert, and if it's and this goes out to 2023, so the risk of the conversion into 22 million shares is quite low, and they're paying almost virtually zero interest. So they've kind of got financing almost for nothing. And then on the balance sheet itself, they've got $362 million in cash, and they've got another $936 million, almost $1 billion in marketable securities, and most of those are like T-bills, corporate debt, that type of thing that's fairly high rated and should be reasonably secure. The corporate debt might take a bit of a hit, as I've been talking about, with interest rates going up in the bond market due to the coronavirus and slowing down the economy. But I just, and then revenues went from 1.35 billion in 2019 to 1.6 billion for 2020. So you can see that solid 20% growth, which they've been doing for the last couple of years. Like all technology companies, a little bit disappointed with the amount of stock options they've issued. There is 26 million options that have been issued to employees, which is almost 10% of shares outstanding. But most of these companies are the same, and unfortunately it's just something you have to kind of suck up when you buy them. So I did mention last year they were cash flow positive, $50 million, and also 2020 they were $50 million cash flow positive. So I think there's a very good chance that they will be profitable this year, and all the debt ratios that you worry about with a new company are basically